Hi, this is Randy Finney with the Right Side of the Chart, and this is a midday market update for Monday, May 6, 2019. I'll probably finish up the day with another video or at least some static charts at the end of the day. I just wanted to do a midday update. Actually, I did one about an hour ago, ran into some technical difficulties after wrapping that video up, so I'm just trying to get those worked out. I'm just going to redo this video here. We'll keep it pretty short. I just want to go over the indexes, what's happened, and what levels to watch. All right, here's QQQ. Let's start out there. As you know, we had a breakdown recently, back to some impulsive selling, but for the most part, we're moving sideways since then. Not any huge, red candles or anything like that. Volatility's picked up a little bit, but this is the range that we've been in now for the last week or so. May have missed the top of that range there a little bit, but here, let's do it like this. So right about here, and what's happened so far today, just like last Thursday, we dipped below it intraday, but right now we're a little bit above the top of that range. You can see here we're at 188.71 versus 187.76, give or take. So here's the point. Right now, as of this moment, nothing technically significant today. Doesn't matter how much the futures were down last night, and remember I say this often, that's not where the big boys are playing. They can't buy Apple or Amazon or Alphabet at 2:30 in the morning on Sunday night or Monday morning, and they can't really, for the most part, the big multi-billion-dollar funds can't play around in the futures market that much. They're just too big. They'll move it. So what they do is, 9:30 opening bell. That's when all the players step on the field, and that's, as you can see, what happened today. That's where they stepped in and they could buy, and they bought the dip. Now, in the trading room, was it on the front page? No, I believe in the trading room today. I'll keep this video for members here, and we'll update this. Here's our QQQ short trade. And I gave two levels. I added a line. It's not on this chart. It was on the chart I posted in the trading room. Two levels to watch today that could come into play as resistance. The 188.60 level, right when we're approaching that, and I mentioned the first 60-minute candle closed right on that level. We pulled back a little bit, powered back up, and I said the next level to watch, which could come into play as resistance today, would be a backfill of this gap right here. See the gap from that's Friday's gap, last Friday's. So that's the level to watch right now. So far, rejection there. But again, it kind of puts us back into that whole trading range. And, although I mentioned, the trend, at least we've been making clearly lower lows in QQQ. Roughly equal highs. This high on Friday was a little below the previous highs. So it's more of a megaphone type pattern. Call it what you want, but you have to recognize it for what it is. And I just see comments back and forth in the trading room, guys. I get it, but don't read too much into this kind of back and forth noise. We need to make a definitive break either to the upside, or at this point, I think a cut under today's lows will do the trick. There was a lot of futures were down big. Buyers stepped in to buy this dip so far today, and if they fade that will be painful for a lot of dip buyers. And I think we'll get not an ultimate WTF moment, not the type I was talking about back in the fourth quarter last year, but I think we'll get a near-term WTF moment. And what does that mean? Well, dip buyers that have been buying the dip. Let's just go back to the chart. This has been the pattern recently. And, all year, this has been, like Pavlov's dogs. When the bell rings, they salivate, they get rewarded. But all of a sudden, if they've stepped in, bought this dip, so far, each dip buying has brought them up to the highs. But if this one falls short, let's just say here at the gap, and we have another thrust down, I think that would do the trick. I think that would wipe out, I know, well, obviously we know it would wipe out everybody that stepped in and bought today. I also suspect a lot of this is a fair amount of short covering. A lot of nervous shorts in the market, and maybe they were just looking to take quick profits when they had them, especially when they saw the buyer step in today. Who knows? We'll see. But all I can tell you is that is the bigger picture. When we go back out again to the daily time frame, we have this recent area of consolidation. And yes, I'm focused a lot on the Qs, but let's just go through the other indexes and a couple key sectors, and we'll keep this one relatively brief. Here's SPY, the S&P 500, and remember, SPY, despite what their cheerleaders on CNBC might have said about the market breaking out to new highs, there's no breakout to new highs. I don't care if we punched up intraday or made a close 1/10 of 1% above the previous high. When you look at charts, this when you get 2-3% above, then you can say that's a clear breakout. Right now, what I see is a failure, a test at least. Not an impulsive failure. I'm not. You can't start high-fiving here and say that as a short or a bear you've won. It's just so far we're testing that level and we're not far below it. So nobody's won yet. It's just again a test of the 2018 highs. We haven't been able to take it out yet on SPY. We had a pretty impulsive rejection there. Went up Friday's big rally, but failed to take out the previous highs, and another rejection there. So, but again, you can sit here and hash through this all day long. Nobody's won yet. We're in this kind of sideways trading range here recently in SPY. And again, you want to see if you're bullish, clear, solid break and close. Big green candle above there. And bearish to see the bottom of that range, but really today's lows. Again, I think if we undercut today's lows, that will have some near-term psychological implications, like I said, for dip buyers, longs, maybe embolden some shorts. So those are the levels I'm watching. And right now, I wouldn't, depending on how you're positioned, and I can't speak to everybody's positioning. I don't know who you bought, where you bought it, but I wouldn't be doing a whole lot. I'm just kind of sitting back watching today. For the most part, I have positions. I'm still, hedging my NQ shorts with an RTY, which is a Russell 2000 long. Oil hit my target today, my second target, and strong divergences. So I played a bounce up to. I'll get to that. Let's do that now, and then we'll continue on with the markets because that's an interesting setup here. So here's crude oil, and personally, CL on this trade. The USO would have hit the target it did hit it in pre-market, and I should probably talk about that. Let me just go here. But this is what's happening. We've been stair-stepping lower. This is a downtrend, so you can see crude is clearly in a near-term downtrend, but we've had these divergences building. Remember, they were there in place last week on Friday, and with that thrust down, perfect opportunity. That 60.46 is a pretty solid target, and it was pretty nice resistance. And so we bounced, but look where we bounced to, right back to 62.03, which was the previous target. And we have downtrend line resistance not far above. So I just gained a small bounce there out of that now, and I want to talk on, by the way, there could be more here. If these divergences play out, we could pop up. Fundamentally, the news, the headlines, the big one was Trump's tweet regarding the trade wars, but there was also a headline that U.S. is sending, what was it, an aircraft carrier? So they're deploying some military forces over to the Middle East for what they deem a credible threat in Iran. Hostilities and tensions over there are usually bullish for oil prices, because it calls production into question, all that. So let's just talk on the USO trade. This is something that I've covered many times in the past, but it's just sometimes these old things bear repeating. There's USO. I'll have to give you well, I can tell you right now. Let me pull a chart. Here, we'll do this chart. This is the 60-minute chart. This is our official trade. Here's where we shorted it right there on April 30th. And it's been stair-stepping lower. Now, this does not reflect this particular chart, pre-market trades. USO printed a low of 1252 in pre-market. If you've been, a member of the site for a while, you've heard me say time and time again, what I think the closest thing to a holy grail in trading, one of the things I highly recommend is the use of OCO orders. One cancels another. So you enter a trade, for example, this one. Let's just assume that you agree with, my, these are general suggestions, just where I think, a stop relative to the final price target, and that's always, if I don't specify otherwise, that would be where the stop is calculated to the final target. And again, you can use, some people might take partial profits along the way. Some might hold out for any one particular target. But an OCO order says, what you do is the minute you enter a trade, you turn around and you set two orders. And again, just call your broker if you're not familiar. Go to their website, do a search. It's either under OCO or OCA. One cancels the other, or one cancels another. and that order would have you a stop loss order. Make sure it's good to cancel, otherwise the default is usually a day order. So you set a stop loss at 1382, good to cancel, and a buy to cover limit order on the short at 1215, and if one's hit, the other will then be canceled out automatically. Now, however, as I say, and this is all on the FAQ page, why I list multiple targets on a trade, not just one price target. Nimble traders can often, game the bounces off these levels. And so what would have happened in pre-market? We went down to 1256. It was a pretty solid support level on USO as well as crude, as I just showed you. And had you had a standing buy to cover order there, and set that order to fill outside of regular trading hours, meaning the pre or post market session, it would have filled. So what I like to do, where I'm going with this, is on my OCO orders, if I'm trading a stock or an ETF, that is, not futures, I will leave my stop order to only trigger during the regular session, because the key in any trade, you want to hit your profit target and you don't want to be stopped out. Pre-market and after-hours trading sessions are volatile. If you've watched this, if you traded for a while and you put a chart on a stock that's going, you'll see some crazy prints way above the current price and way below. That is because there are a lot of retail traders, inexperienced traders trying to play around. And when you put a trade in after-hour session, you can't use market orders. It has to be a limit order. And some people, I'm guessing this is why this happens. I see prices all over. They key in the wrong price, and boom, somebody's going to fill that order. Somebody out there is going to see an order sitting well below the price if they want to go long, buy it, or well above if they're short. And the thing is, so if you leave your stop loss order to only trigger an outside, and in the regular session, you're much less likely to have that stop just clipped during some crazy little spike in the after-hours session or pre-market. However, the goal of any trade is to fill your order. So if you were targeting T2, even just to play a bounce and then get back in, that order should have been set outside to fill outside of regular trading hours. What that means, if you tell your broker, allow this trade to be filled outside regular trading hours, it's usually a selector on the order entry. It's also good for regular session. There's no they go hand in hand, especially if it's good to cancel. So therefore, that would have been a nice exit there. And you can see here it doesn't even reflect because we bounced here. Let's just look at the 1 minute chart. There it is. It's kind of sloppy on USO, but that's what the 1 minute chart looks like without showing the pre-market trades. Again, it went down to 1252, and now we've had that bounce back. So yeah, this is what it looks like if the after-hour trades are showing a little dip down below, and now we're back to that point there. And you can also see there's down close to being downtrend line resistance, not perfect, but more importantly, we have quite a bit of resistance overhead. So, and there's a divergence on the USO 60-minute chart as well. So again, fundamentally, there could be more upside. My near term, I'm a little undecided. We didn't hit T2 yet. Officially, because I don't consider the trades outside regular trading hours to count as a trade. So I'm going to leave this on, and right now, technically speaking, we just hit this target, although some of you might have exited in pre-market. If and when T2 is hit, that's the other thing I want to talk about, trading plans. When you have a trading plan, you enter a trade, unless something very compelling changes, stick with it. And be patient and let the charts play out. If and when we hit T2, which I still think is possible, although if there was enough evidence in the charts to close this trade out completely, I would do so. As of now, there's not, so I'm leaving it on. You determine whether you want to lower your stop now that T1's already been hit or not. But if and when we get to T2, then I will most likely lower the stop to entry at that point to at least assure a break-even on the trade for anybody that hasn't taken profits at that point. Okay, bit of digression there, but again, we don't have many official trades, so I might as well cover that one. And oil was, I think, worth mentioning today. So let's just look at the rest of the markets here, the rest of major indexes. So here's SPY, story on SPY. Again, kind of in that sideways trading range. It broke down before XLK and QQQ, and because of that, like I said, SPY isn't going to go anywhere without the tech sector. So it drifted up and back tested until XLK broke. But we still need to, again, make an impulsive move down below, especially under today's lows. Let's look at XLK. There it is. That to me is keeping my near to intermediate term bias as bearish right now. Still expecting more downside. Anything is possible, but when I look at this chart, and again, this is by far the largest sector in the S&P 500, and about 1/5 of the returns come from this sector alone, much more than any other sector. And so therefore, you have what is clearly a breakdown and a backtest. I can play around with this trend line. I had it like this before, and with a little whipsaw there, but actually, yeah, we closed about right on there. So we had a breakdown backtest. If you want to give it what I call the benefit of the doubt, trend line, come in and catch all these candles at the lows. Any way you slice it or to dice it, this is a breakdown and a backtest in XLK. In today's candle, although we've recovered a lot, the tech sector is still down 1.5%. So keep that in mind. And when I box in the range here, I'll go right here, come in here, box in the recent trading range, the sideways range. We're just back testing the bottom from below. So that is resistance. It's a minor resistance level, but again, I'm capturing the bottom of all these candles right here, and that red candle last week, the body of that candle is there as well, and that's about, I'll tell you where it is. Give or take, it's about 77.85 or so, and so that puts XLK, on a sell signal. There's no other, that's it. That's a sell signal. Breakdown, divergence at the high, and that tells me there's likely more to come. So we'll monitor that. If it changes, we come back up. Sure, is a back test possible? Possible. Is it possible we get more than just a back test? We keep going to new highs and burn through the divergences? Sure. But as of now, I don't see anything in the charts. Not a single thing that tells me that this breakdown has failed or is even being called into question at this point. And so, as you know, that was a sector I was putting a lot of weighting on. Let's just look at a few other sectors and we'll wrap this up. XLI, industrials, sort of the same thing here, boxing in this recent trading range right now. So this is a common theme from this video is, the bearish case can be made right now, but it's not a screaming all-in short. The trend has been very resilient. We've seen plenty of false breakdowns in the last or all year so far. But again, I'm looking at a lot of sectors and stocks and even the indexes. Today's lows seem to be about the bottom of that recent trading range. And XLI, just like the majority of the sectors in the S&P 500, are still well off their highs. There's only it's about a little less than half, I think, and some of the unimportant sectors like the REITs and utilities that are making new highs. And also, so again, they don't have a big weighting in the S&P 500. Industrials do. They're nearly a 10% weighting in the sector. Half of what tech is, but still one of the largest sectors. So that's that. So again, watch for the breakdowns there, and it's all this too. It's not just the fact that we've broken trend, but it's the fact we've done so while very overbought with negative divergences. So you've heard it 100 times, but it's worth repeating in my opinion. XLY, one of the bigger sectors as well, another 10% weighting, and watch this one carefully. What we have here is a breakout to new highs. This is one of the few sectors that broke out to new highs, and you can see it's pretty well defined. There was your high in 2018. We hit it, failed, came back, powered up, but it was actually a fairly impulsive breakout. But again, there were other variables. If you're trading only this in a vacuum, sure, you would have taken that breakout. The reasons that I didn't, and I suspected it might fail, it hasn't failed yet. Right now, we're just back testing it. You can see that. There's that level, about 118.12. We're a little bit above it. But again, we're very overbought. And we had not even divergence here, but a lot of the sectors and indexes did. And we had a clean trend line that was broken as well. So again, common theme of this video is this market can still go either way. But to strengthen the case that we're going to have a decent correction coming up here, and I'm talking, another 5% or more downside, you want to see today's lows go. You want to see them go with conviction. You want to foil the bearish case or strengthen the bullish case. That would be a break above the recent highs in just about everything, most sectors and the broad market. So that's XLY, XLC. Another big one, also about 10% weighting, and we popped. This is not a very well-defined trend line. This is a new sector. It replaced the old telecom sector, and we popped down below, and we're pretty much right on the trend line right now. So one to watch, certainly. And again, kind of became very overbought at the recent highs, and it's starting to come in off those overbought readings. Let's see. Let's talk about XLE energy. I already mentioned this last week. Impulsive breakdown, fell right to support, so it's kind of holding its own right here in the support zone. Had negative divergence at the highs, so not a surprise that we broke down. And if the market's going lower, this is probably just the first leg down. Maybe this is some type of flagging or bearish pennant action. We come on down here to that next target if the lows are undercut. So again, it's about the market making another thrust down that takes out today's lows. Will also have technical significance on a lot of sectors as well. Let's see, financials. That's worth noting. XLF broke this trend line here, this minor trend line. It's a little wedge type pattern, and if you recall recently, we had I was watching this level, 2752. Lots of reactions going back for a while here on that line, and more importantly, the Q4 rally, we had two failures there, a lot like the broad market, and so I also a lot like the broad market, we popped above it, but I suspected at the time, and I still do, that this may prove to be a failed or false breakout. So far, lack of follow through. When we popped it, the first green candle, we did nothing but trade sideways since. Now we're back testing it. So again, how you want to look at this is up to you. If you are bullish and the glass is half full and the market's going to new highs, this is where you step in and buy. A breakout and a back test of the breakout right here. That's former resistance is now support. But like everything else, the financials are making a series of lower highs. They're well off their early 2018 highs. So again, let's not read too much into this. This trend line isn't super well defined. It is worth noting there is an impulsive breakdown below it today, although we're back testing at the moment. Even though that's a red candle, we're right at the top of that red candle. So you can say that this is, I can tell you technically speaking, an objective short entry on XLF because it's broke down. But we haven't had a daily close above here, number one. And more importantly, we kissed the 2752 former resistance, now support level. So for me, I'd want to see that level go, 2750 or today's lows, go with conviction before shorting. This kickback here, this could just be a whipsaw signal. So again, there's another sector that if it drops below today's lows, it will have failed that recent breakout. And so there we'll get some significant technical developments, if you will. And then we'll just click on XLV, pop this 88.58. It was support. When it broke, we had a impulsive sell-off, and it's back testing that level now. That was support before and may come in again. If it breaks, it may trigger another leg down. If not, if the market can gain some traction today, continue to build on these gains, close some or all of today's losses, XLV may come up here, and that may offer an objective short entry. It may also offer an objective long entry if it breaks out. You can see my resistance level, so that could be a possible short if it gets there. If it breaks above that level, it still has a little bit of resistance here around 92.42. So one to watch. Charts aren't super clear now. I had planned to, I was considering shorting this one and still am, but I just want to see a little bit more evidence in the broad market before I go too crazy. We have two shorts right now, which are pretty broad based. We're shorting oil and QQQ, which is not the entire stock market. It's pretty tech heavy, but there's some other things in there. It is a sector. I'm sorry, an index. And so we'll see what happens. We may get another short op here or a sell signal on the healthcare soon. But right now, just kind of holding off on that one, but watching it closely. All right, that's about it. XLP, consumer staples, still off the highs like so many other, most of the key sectors in the S&P 500. And there's a trend line. So this one hasn't broken trend yet. XLRE, the REITs, they're not going to move the needle on the S&P 500 because it's only about a 3% weighting, but they're back testing right now, and they've been for a while. I've pointed this out. We broke this little minor trend line here, and like price channel right there, and we've been back testing. We haven't really rolled over yet, so you want to watch it. And if we do, my target would be down here around $34, next swing target. And of course, SRS is a proxy, a 2-time leverage short. We talked about this one before. So right now, again, I'm just want to wait and see how today closes. If it's an ambiguous close, doesn't tell us much, gets back in that range, then it might be just more of that this week. We'll just have to watch it. But like I said, I can't really squeeze water from a rock or blood from a stone. I can't extract too much into today's price action at this point in time. So let's watch those lows. Let's watch those highs. See if either get taken out. And until then, just be patient. No reason to be aggressively long or short, I think, at this point in time, because the market could continue to chop around for a while, and in doing so, it's going to A, frustrate you, and B, probably run your stops. As I said, if you run you're shooting 10% price target on a trade, and with a 3% stop, and the market's grinding around in a 3-4% range, that stop will probably get hit on your position, especially if it's correlated to the broad market. All right, we're going to wrap it up here. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed.